Welcome to the Deep Dive. Today we're putting together the Investor's Survival Kit, Crisis-Proof Your Money.
Right, and we're drawing on some real heavyweights here. John Mogul's Common Sense on mutual funds.
And Benjamin Graham's The Intelligent Investor. Classic stuff.
Absolutely. The goal really is to give you the tools to, well, not just survive market storms, but maybe even come out stronger.
Exactly. So let's dive in. John Bogle, the Vanguard founder, he lays down some really foundational advice.
He sure does, that core idea.
Yeah, he famously said, time is your friend. It's all about consistent, long-term investing. Stick with it.
And the flip side.
Impulse is your enemy. He really hammers home that you got to take emotion out of the equation. Keep it mechanical, disciplined.
It's so easy to get caught up in the noise, isn't it? Chasing hot stocks or trying to time the market.
Right, and Bogle argued that's mostly a distraction.
Yeah.
He believed the real secret is, well, simplicity.
And low cost. That's something both Bogle and Graham hit on again and again. These cost-expense ratios, trading costs, taxes, they might seem small.
But they compound relentlessly. Bogle called it the tyranny of compounding.
That's a powerful phrase.
It is. He showed how maybe, say, 1% in annual fund expenses doesn't sound like much.
Right, 1%.
But over decades, that could literally shave off a third or even more of your potential wealth. Just gone. Poof.
Wow, just eaten away by fees you barely notice.
Exactly. Which leads to the obvious question. What's the most straightforward way to fight back against those costs?
And Bogle's answer was pretty clear. Index funds.
The simple solution.
Yeah, low cost, tax efficient, and the kicker. They consistently tend to beat most of the actively managed funds over time.
The data backs that up pretty strongly.
It does. Think about it. The total stock market index has historically outperformed the average diversified stock fund by a pretty wide margin, even investing legends.
Like Peter Lynch.
Yeah, Peter Lynch, Charles Schwab, they've both basically said most investors would be better off in an index fund. That's quite an endorsement. It really is.
Yeah.
So Bogle gives us the what index funds and the why, low cost, simplicity. But Graham gives us the mindset.
The intelligent investor. Crucial for navigating the ups and downs, right?
Absolutely crucial. He famously described the market like a pendulum, swinging back and forth.
Between optimism and pessimism.
Exactly. Unsustainable optimism at one end, unjustified pessimism at the other. The intelligent investor, they're a realist.
So they use those swings.
Right. Buys from the pessimists when things look bleak and prices are low, and sells to the optimists when everyone's euphoric and prices are high.
And importantly, he warned against chasing trends.
Oh, definitely. Never buy a stock because it has gone up or sell one because it has gone down. Trying to predict those short-term moves, he thought that was mostly a losing game for average folks.
And building on that, he was really wary of speculative bubbles and these new era investment ideas.
Called it a fool's errand. He distrusted complex formulas or theories that claim to predict the future.
Right, like if it sounds too complicated, maybe it is too complicated, or just speculation dressed up as investing.
Precisely. And for Graham, the real risk wasn't just prices bouncing around volatility. He actually found focusing too much on volatility more harmful than useful.
Okay, so what was the real risk then?
Permanent loss of capital. Paying too much for something in the first place. That's the danger you need to guard against.
So it's not about predicting, it's about protecting.
Exactly. Graham championed protection over projection. Protect yourself from overpaying, protect yourself from your own overconfidence.
That makes sense. And how do you do that practically?
Well, much like Bogle, he saw broad diversification as key for most people. An index fund covering the whole market, for instance.
Low cost again, and lower risk compared to trying to pick winners.
Yes. Significantly lower risk than actively managed funds as a group. It brings us back to that idea of simplicity and discipline.
So let's boil this down for everyone listening. What's the core of this investor survival kit?
Well, pulling from both Bogle and Graham, it seems to be about sticking to the basics.
Simplicity, definitely. Keeping costs incredibly low.
Thinking long-term, having that discipline. And maybe most importantly,
resisting the emotional roller coaster. Don't panic sell, don't greedily buy at the top.
Precisely. Be an investor focused on underlying value and long-term ownership, not a speculator chasing quick price moves.
So here's a final thought to chew on. We live in this incredibly complex financial world, always looking for the next edge. But maybe the ultimate survival kit for your money isn't about complexity at all. Maybe it's just about consistently applying these few profound, simple truths we've talked about today.
It's definitely something worth thinking about.
Something to mull over until our next deep dive.